Hi, welcome back to Cheryl Trades Leaps. Most investors think they only have two choices in a market drop. They either panic sell or they sit there and watch their portfolio bleed. But there's a third option, and it's what smart money does. Because professionals don't react to the market, they adjust to it. And once you understand this, you stop seeing drawdowns as something you need to escape and start seeing them as something you can manage. The retail trap. Let's start with what most people do. The market drops. Fear kicks in. And suddenly, everything becomes urgent. They start selling positions like Microsoft Corporation or NVIDIA Corporation, not because the long-term thesis changed, but because the emotion changed. And this is where the biggest damage happens. Because panic selling doesn't just lock in losses, it disconnects you from the recovery. You sell low, and then you hesitate to buy back higher. So you end up missing both sides. The smart money shift. Smart money doesn't think in extremes. They don't ask, should I sell everything? They ask, how do I reduce risk without destroying my position? That's a completely different mindset. Because their goal is not to escape volatility, it's to control it. The hedge, not the exit. Instead of selling core positions, smart money keeps them and overlays protection. This is where tools like inverse ETFs come in. For example, ProShares, short QQQ, ProShares, ultra short QQQ. Now this is important. They're not trying to bet against the market. They're trying to balance their exposure. So if the market drops, the hedge offsets part of the loss. If the market recovers, their core positions still participate. Volatility versus loss. Here's a subtle shift most people miss. Retail focuses on losses. Smart money focuses on volatility. Because volatility is what drives emotional decisions. When your portfolio swings too hard, you react. You override your system. You make decisions you normally wouldn't make. So instead of trying to eliminate losses completely, smart money reduces the intensity of the swings, and that changes everything. The psychological edge. This is where hedging becomes powerful. Not just financially, but psychologically. Because when your portfolio feels more stable, you think more clearly. You stop panic selling, revenge trading, forcing entries. And this is the real edge. Not prediction, not timing, but emotional control. Thinking in scenarios. Smart money doesn't try to predict the market. They prepare for outcomes. They think in scenarios. If the market drops, I'm protected. If the market recovers, I'm still positioned. This is what gives them confidence. Because they're not dependent on being right. They're prepared for being wrong. Scaling, not reacting. Another key difference. They don't move all at once. Retail goes all in or all out. Smart money adjusts gradually. A. Add small hedges, increase if needed, remove when conditions improve. This keeps them flexible, controlled, rational, important. Warning. Now, I want to be very clear about something. Inverse ETFs are not long-term investments. They are short-term tools. They can decay over time, and if you hold them too long, they can hurt your returns. So this is not about replacing your portfolio. It's about temporarily managing risk. My personal moment. I've been in situations where the market starts dropping, and you feel that pressure to act, to do something, anything, just to stop the pain. And that's when most people make their worst decisions. Not at the top, not at the bottom, but in the middle of uncertainty. Final takeaway. So the next time the market pulls back, don't think in extremes. You don't have to panic sell, and you don't have to sit there and suffer. There is a middle ground, and that's where smart money operates. They don't abandon the ship in a storm, they adjust the sails. If this helped you see the market differently, subscribe for more leaps-focused strategies and frameworks. Because this isn't about avoiding volatility, it's about learning how to move through it, with control. Thank you for watching, and see you in the next video.